India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi, good morning.
Hi, good morning, folks. And hi, good morning, Nigel. It's a new look. I think we're taking a bit of a different approach today.
Nah, I mean, just adapting to Mumbai winter, so to call it. Unfortunately, I don't get to anchor from Delhi. Otherwise, I could have worn it more often. But yeah, it's part of the New Year, Christmas look. Yeah. Once, twice a year, we get the green signal. Might as well go for it.
We enjoy our little winter, whatever it is, 2-3 weeks.
This time of the year, I mean, Delhiites are out with their coats and
mufflers,
scarves and their
the boots.
Yeah.
It's stylish. So I think we're bringing some of that here.
Good. Well done.
All right.
But otherwise, for the market, I mean, it's. I guess now we have Wall Street also slightly iffy, but then I mean, we've had our own issues for a long time.
Yeah, the good thing is that the market here is already sort of compressed quite a bit. A fair bit of selling has happened. So that's the hope, right? I mean, the damage is, a lot of damage here has happened, which of course has not been the case, especially in the US, which of course is on a different planet pretty much. But let's start with the basics in terms of what you need to know as we begin this session. The fear last night, and I'll get to the prices and the price action in a bit, but the fear essentially was that the Fed essentially is going to be a little on hold for a little longer on the back of stronger economic data. Now, the data I will refer to in just a bit, but the price action, S&P was down about 1.25%. Nasdaq was down almost about 2% or so. Rates market, the 10-year was up 6 basis points. We are back to about 4.7%. The dollar index, which had cooled off a little bit, it's still not at the highs. That was past 109 levels. We're at 108.7, but was up 0.4% or so last night. Oil prices at about 77. They're up about 1% or so. Now, the data points, right? So you had the ISM Services Index, which has reached the highest level since 2023. Services is the sticky part of the economy. It's the larger part of the economy, pretty much across the board in the developed world. And that is sort of firing. That is looking good. JOLTS, that is the job openings in the US, that also beat expectations, consensus expectations in a decent way. So these are essentially two things at the margin, new things, which the market kind of read into and said maybe the Fed, the first sort of cut, first of all, by the way, in 2025 now, the expectation is 2 cuts in 2025 from the Fed. And will the first cut of 2025 only be in somewhere in June or July? It's possible. And market pricing is moving like that. And that's the reason why you saw the reaction in rates and consequently, equities coming off as well. By the way, it was a bit of a rough session for AI stocks as well. There was all that excitement about NVIDIA and the CES, the big conference, Jensen Huang, the NVIDIA chief, making that keynote address. NVIDIA ended down about 6.5% last night. Now, Trump, the incoming US president, gave a press conference. It emphasized tariffs on Mexico and Canada. We will play out sound bites on that. It was, as always, fire and fury from Mr. Trump. To me, it was not what he said, because what he said was, it was a repeat of what he said before. It was what he did not say. The one thing he did not touch upon was China tariffs. We're not reading too much into it, but there was no mention. He talked about tariffs with regards to Mexico, Canada, but nothing about China. Now, just to sort of come back to the levels here and how we've left off. So yesterday we had a good session with the bounce that we saw, much needed. The broader market did even better. So it's back to tracking day-on-day price action. Hourly averages for the Nifty, as you track, if the recovery has got to sustain, it's got to take out hourly and then daily averages. The hourly averages converge around the 23,815 level. Yesterday at the day's high, we were just short of the 23,800 level. So that's the first cluster of resistance. And then, of course, you've got the short-term daily moving average, which is 24,045. These are all very near-term compared to where we left off yesterday. On the downside, a break below 23,551 will tell us that the structure is weakening further. So you got to take it bit by bit. The Nifty Bank, similarly, I'll start with on the way up. Again, a decent day. Better than the Nifty, by the way. Resistance at the 20 hourly average, which is 50,460. and then the 40 hourly exponential moving average, which is 50,690 or so. And of course, on the way down, 49,751 is the level which the Bank Nifty should not break. Again, very near term, but as I said, it's got to be day on day as we track the recovery or further weakening here. So that's essentially the setup. GIFT Nifty will come up on your screen. A quick look at what the start is indicative of, about 30 odd points lower. Surabhi.
Okay, well, absolutely. And the Asian markets have kind of taken over that week handover from Wall Street and this big tech sell-off that we had. And most of them are now flashing red. There's more red than green on the Asian screens, including big markets like Hong Kong, Nikkei, etc. In terms of additional news flow out of Asia, mainly two big talking points. One is inflation in Australia, which is accelerating. The second is Samsung, which is a very, very large MNC. Their profit forecast for the fourth quarter isn't all that great. The market's not too enthused, but those shares are holding up in South Korean trading for what it's worth, at least right now. So that's the overall picture. The markets across Asia are also tracking exactly the very same thing, the move on the dollar. The dollar index is still below 109, but that acceleration that we've seen in the last 12 to 24 hours, that's something that's being watched very, very carefully, as well as, of course, the further moves in the yields. Now, let's come to cues over here. Yesterday, at 4 o'clock, we had the first advanced estimates of GDP coming through, and that has been a talking point. Now, for the market, it's not really a shocker. Because the number is very, very much along expected lines. What we're saying is now 6.4%. It's a sharp deceleration from last year's numbers of 8.2%. But for the market, like I'm saying, it's not new. However, when you see the numbers, it kind of just drives home that same point. Actually, the estimates for agriculture are much better. In terms of overall GDP, agriculture is much better than manufacturing, because look at the manufacturing number. It's 5.3%. That's the growth estimate for this year compared to manufacturing touching almost 10% last year. So that dip is sharp, and that's why we've seen the slowdown in earnings and therefore the market as well. We'll have more cues on this. Lata will talk us through some of the other salient features. Remember, it's all about an expected pickup in government spending in the second half, whether that's going to happen or not. Gross fixed capital formation is being projected at about 6.4%. More on this in just a bit. Now let's come on to the fund flow picture. Not too much to sort of, speak about over here, but the fact is that FIIs were again on the sell side. We've just gotten so used to that, 1,500 crores of selling coming in. It was absolutely offset by the domestic buying yesterday, so that was good. But what seems to be very clear that the kind of capitulation that we saw on Monday, which was perhaps HNI or direct retail stocks, stock players, that probably is out of the system. So the institutional flows are offsetting each other. Finally, in terms of a sector to watch today, maybe today and over the next couple of days, I'm going to keep a spotlight on the auto names, specifically the PV manufacturers. Yesterday, Mahindra & Mahindra announced the pricing for their electric vehicles, the ones with the larger battery packs, the 79 kilowatt hour. And there, the BE6 is priced at almost 27 lakhs. The XEV9E, now that's priced at 30.5 lakhs. Why am I watching for this? Because if these models start getting sort of adopted well in the market, and I think they're promising delivery starting Valentine's Day, look at the price tags and imagine what this can do to the margin profile for a company like Mahindra & Mahindra. Very, very critical as we go forward. And finally, even Maruti. Watch for Maruti, not just today, but the coming couple of days. Maruti is now talking about its own EV ambitions. Yesterday, it revealed the identity. The entire blueprint is called E for Me, and more details and the launches, and they're talking about setting up the entire EV ecosystem. All that will be announced during the Auto Expo, which will take place later in January. So auto definitely in focus for me today and over the next couple of days. But Nigel, what are you watching for?
Well, that's right. The global queue is actually a little bit iffy because you don't know what US President Trump is going to do when he takes over office on the 20th of January. And also there is that uncertainty with regard to the Fed rate cut action. But all these three indicators on the screen, they need to consolidate a little bit, or they need to peak out a little bit. And because all of them have moved up a little bit overnight, that's a bit of a worry for the emerging markets, and India included as well. So that's about the global picture. What did the FIs do? Well, in yesterday's trading session, they added long as well as short positions in trade. And now that net short positions from around that 80 to 83% odd, it's come down to around 80%. They continue to remain net short, though, on the index with more than 2 lakh contracts on the short side. I was going through an Ambit note, and they said that, more often than not in the last few years, when FI short positions are at this level, we do end up higher in the next 6 months or thereabouts. So let's see whether or not this time as well that holds out as well, because the short positioning is at around 2.2 lakh contracts. Clients, well, they are flipped it over. They're on the opposite end of the spectrum, more than 65% of their positions on the long side, with the net long positions as well out there. But in the last couple of sessions, besides what the FIs are doing in the cash market, they have been adding some long positions as well on stock futures. And that's precisely what they did yesterday as well. So though we ended a little bit higher yesterday, on select stocks, it appears that they added longs and they covered some shorts as well. Though in the last few days, another point to notice, clients that are aggressively net long on stock futures, they have unwound some long contracts on individual stock futures. Keep in mind, clients and FIs on stock futures, both of them are net long. But clients, particularly in the last 2 to 3 sessions, they have unwound close to 45,000 long contracts on stock futures itself. So that could be one of the reasons why we're seeing some kind of pressure on select stocks. Moving to the levels that you're looking at, the 200 EMA, most important. You will get a little bit more confident from a bullish perspective once you get past this level. Otherwise, on the downside, you don't want the recent low to get broken out, which comes in at around 23,460. The Nifty bank yesterday showed signs that it wants to fight back, but it met with resistance at around that 50,500 odd mark. So yesterday's high is important. The 200 EMA, this is an important resistance zone for the Nifty bank, while the reference point is the recent low. The stock that I'll be tracking on from here on is Reliance Industries. 2024, big underperformer, underperformed the index by around 15%. But now Jefferies has put out a note and they're saying that valuations is the lowest we've seen all the way since COVID lows. And maybe that could be the much needed trigger, because they're saying for 2025, there are various triggers that are lined up. The recent lows around 1,200 rupees odd, you'll want it to protect that. So that's the stock I'll keep an eye out, particularly because you're getting some valuation comfort.
All right, absolutely, and it's going to be interesting year, especially some of these beaten down large cap names. Sandeep Nandan at Quant, for example, was with us last Friday, and he made similar points that the hated large caps of 2024 need to be on your radar.